watching Closing Trades right here on ET Now, and pretty much in line with the rest of the globe. We are also bleeding red. We're down about 1%. Having said that, it's a marked recovery that you've seen from the session lows or that gap down start. Pretty much it's been a one-way move up, one would have to say, at least directionally. So covering our losses now, we're down only 165 points, and I say only 165 because it was a lot worse. When we came into trade, we were down over 300 points. That said, all sectors other than perhaps chemicals, they are still in the red, led by infrastructure, banks, power, textile, oil and gas, autos, FMCG. It's all bleeding red as we speak. The bigger cuts coming in for names like Adani Ports, SBI, IndusInd Bank, Eternal, HDFC Bank, ITC, L&T, etc. But yes, the dots of green continue for IT and then defense names. Look at BEL, that's still standing tall with about a 1.6% gain. Or for that matter, some dots of green within the broader end of the market. A Manappuram, for instance, is holding out along with a Muthoot, a Jubilant Foodworks after a brokerage note that's looking up by about 2%. Or for that matter, Max Healthcare, which is sitting on a gain of about 2.6% or slow. Slight bit of recovery from the session lows for Interglobe Aviation, although it's still a rank underperformer and the top loser within the F&O universe. Canara Bank, which is still down 3.7%. Angel One, BSE, Granules, Union Bank, these are all still laggards in trade. But Snehi, what about the newsmakers?
Well, big newsmakers today, like you mentioned, Interglobe, but other than that, also on the back of these West Asian tensions simmering, a whole lot of oil sensitives, the likes of HPCL, IGL, from the OMC pack. You have some other stocks from shipbuilding, SCI in focus today. SCI and Garden Reach are doing very well in today's trading session. But once again, if you shift focus and talk about these oil sensitives, be it paint stocks, tire stocks, these stocks have been under a slight bit of a pressure today. Oil India had seen some sort of recovery. So we'll just see where Oil India is right now. Yes, a 1.2% uptick coming in on Oil India. So that has tilted over to the green in today's trading session. This, of course, on the back of trade tensions as well as the geopolitical tensions that we're seeing between Iran and Israel right now. Other than that, we did speak about block deals in the beginning of the show, and one such stock that's soaring away on the back of a block deal that we've seen in the first half of the trading session is Jubilant Foodworks. Word on the street is the promoter group is offloading stake to fund an acquisition. Of course, finer details we'll have post-market hours today. But so far on Jubilant Foodworks, we've seen a block deal wherein 1.6% equity has changed hands in 5 blocks. That stock is holding up well amid a largely consolidating market, a 2% uptick coming in on Jubilant Foodworks. It's not only Foodworks because you have other Jubilant group of stocks, Pharmova and Ingrevia. They are also up on the back of block deals in their individual and respective counters as well. The other stock that we're watching out for very closely in today's trade has been L&T Finance. We've been tracking this ever since the market opened today on the back of a negative note coming in from UBS, wherein they have downgraded the stock to a neutral from a buy rating. But on the flip side, they've hiked the target price to 210 from 177 earlier. A little bit of a pressure continues to remain on that stock, 0.8% lower. So these are a couple of stocks that are doing well in today's trade. Other than that, surprisingly, it's the IT pack that has once again managed to flip over to the green. A little bit of a green coming in on IT names like Tech M, Coforge, TCS, LTI, Mindtree and Wipro are holding on to tinge of green, but nonetheless some positivity seen in the market over here. So these are some of the stocks that we've been watching out for. But we also have Kunal, who's joining us in the studio today. And Kunal, it's panning out exactly like you had predicted in the morning. You know, we started with a gap down and you had said that there will be some sort of recovery, and that is what has happened. Has it been to the extent you had pegged it to be? Has it been a little bit more than what we had expected?
No, I think it's more or less in line. 24,700 is where I'd expected the markets to settle, looking at the way the option positions have been built up. The most interesting part which I'm seeing today is that, the courage of intraday traders, especially from the option side. I was just looking at the 3 recent strikes or the 3 at-the-money strikes for, the calls and the puts on the index futures going into the weekly expiry. And interestingly, the stance from the put writers is almost twice as compared to the call writers. So just to give you numbers, the 3 recent strikes, which is 24,500, 24,600 and 24,700 mark, has seen an OI built up of almost 1.5, 1.6 lakhs. as compared to call writers, where you're seeing just about a 65,000 to 70,000 increase in terms of OI, which means that the market participants are expecting that maybe on Monday we may not see a major follow-through move on the downside. There's a gap which has been created today on the index after this gap down opening. That gap may probably be partially filled, and we may see a further attempt towards, say, another 50 points to 100 points on the upside for the index. So it's not as negative the markets are closing into as compared to the start which the markets were facing.
Absolutely. But Kunal, what about the trends that you're witnessing in the market? And you've been flagging off strength in IT, for instance, for a while now. That's perhaps the only sector which is holding out. And then, of course, I guess the leadership now lies in BEL, quite evidently.
Yeah, I think it's great to see many of the defense counters. They're still persisting with the kind of price uptrend and the volume uptick which these stocks have shown. So ideally after a 30%, 40% jump into stock prices in a matter of 2-3 months, you expect that these stocks may come into a time-wise or a price-wise correction, time-wise and a price-wise correction. But it's been a different kind of a correction for a stock like BEL. Even in the last 2 weeks of this minor price consolidation, the stock is continuously making a higher high for itself. So I think 395, 396 was the high, or closer to the high the stock made yesterday. Today also the stock came closer to 397, 398 mark on an intraday basis. So that's the kind of strength the stock has been exhibiting. Indicates that this is a trend which is here to persist as well as sustain for the stock price. For IT index, I strongly believe that if these stocks get maybe one more leg of an up move, the likes of Infosys, HCL Tech, Tech Mahindra, etc., I would probably believe that we could be looking at least another 5 to 10% on the upside. So maybe just wait out for one more day. If these stocks get a follow-through up move, say on Monday or start of the next week, then I believe that we could be looking at a substantial uptick for many of these IT counters.
So IT looking slightly optimistic amid a market like this. But Kunal, there's another pocket of stocks that's doing very well today, and that's the shipbuilding end of these defense stocks. And for instance, you have SCI that's up 10.5%. You have Garden Reach up almost a 3% uptick coming over there. GE Shipping is looking good. You also have a BEML from the defense pack joining these names. So largely we understand this is on the back of the geopolitical news flow that we're receiving. But what is the strength looking like on the charts? Because for something like a shipping corporation, 10% spike is, do you believe it is sustainable going ahead?
So maybe I think for these few odd stocks where the percentage gains is very high, backed by some exceptional volumes. I think for SCI, the volumes are at one of the best days for the stock in the last many weeks. Same is the case with the other stocks. But I would probably believe that this could be one-off move into the stock price, at least over the very, very short term. Maybe these stocks may not see a very similar kind of a price uptick going forward over the next couple of days, because when you see such kind of a sudden price action move, and the markets generally find that these are the kind of hubs which the market participants are concentrating towards, and that's where you don't generally get a follow-through price uptick move. So I would probably expect that SCI, GRSC, etc. May not see a major follow-through up move over the next couple of days. But I think on the contra, you may actually see many of these other defense counters, the ones which we just discussed, HAL, BEL, etc. These stocks can actually see a much more higher probability of a strong uptick going forward.
That's the take coming in on the texture of the market. There's, of course, Muthoot, Manappuram. Those are stocks which continue to hold out as well in today's trading session. But that said, let's just throw light on what's really happening around the world. You've got the Israel now striking Iran, the kind of impact that it's having on crude. Let's try and, probe that a little bit, because, of course, it has a lot of economic ramifications as well, besides other things. Let me welcome on board then Alistair Newton from Alavan Business Advisory joining in on the show right now. Alistair, hi, great to have you on the show. Firstly, help us understand, how long is this going to last? First it was Israel and Gaza, now it's Israel and Iran.
Well, I think, first of all, let's isolate Israel-Iran. After all, the conflict in the Middle East has been going on for 20 months now, and markets, by and large, have ridden it out relatively smoothly. Obviously, as a result of Israel's surprise timing on the strikes, which occurred at 3 a.m. local time this morning, we have seen Brent go up to $78 a barrel and then drop off a bit. I think markets are going to have to get used to the fact that this phase in the conflict between Israel and Iran is likely to go on for some weeks, even if we see American military intervention to support Israel during the course of the ongoing action.
Okay, Alistair, also help us understand what the impact could be in terms of markets globally. We're seeing US futures have already taken a nosedive. You have certain gas counters globally also that are not doing well on the back of the news flow that the gas pipeline between Iran and Iraq could be under trouble, although we have a news coming in from Iraq that is looking safe as of now. What could be the global impact of a situation like this if it were to escalate further?
Well, first of all, clearly, I do think it is going to escalate further because we are going to see Iranian retaliation. We're going to see more Iranian strikes back at Israel. It is likely that if that comes in the form of ballistic missiles, that the Israelis will get support from America and possibly others in efforts to intercept those missiles before they actually reach Israel. So yes, we are inevitably going to see some escalation. It's not clear exactly how much at this stage. To go to your question, though, if we look back at the pattern for the last 20 months since 7 October 2023, what we have seen very consistently is when there has been a new development, a new phase in this conflict, an escalation of some sort, we tend to get a spike in oil, not as big as the one we've seen over the course of the last few hours, but nevertheless a spike. And then over the course of the next few days, market concerns have eased and oil has reverted back somewhere towards where it was before that spike took place. Irrespective of what happens over the course of the coming days and even weeks, I can't see any particular reason why we should not see that pattern repeated yet again. Now, you're going to hear a lot of talk about the possibility of the Iranians looking to block the Strait of Hormuz, and clearly there is going to be some hesitation immediately over traffic going through the Strait of Hormuz, which carries around 20% of global seaborne oil at any given time. But it's remarkably difficult to close the Strait of Hormuz physically, even if the Iranians attempt that. And keep in mind, there's a lot of US naval forces parked offshore, which are likely to do whatever it takes to prevent that from happening if the Iranians do try. And furthermore, let's keep in mind that the global market is actually awash with oil. There is a big surplus of oil on the market already today. And the OPEC plus 8 are about to put another 411,000 barrels a day into markets with effect from the 1st of July. So I'm not particularly concerned about the oil price. I think if anything from where it is today, we are looking at it reverting back somewhere towards the previous norm in the $65 to $70 a barrel range.
Yeah, it seems like what you're seeing right now is at best a knee-jerk reaction, perhaps. But, just diving a little bit deeper into the economic ramifications, Alistair, of what's going on with the strike on Iran right now. I guess chemical exports from Iran and natural gas are the two resources which would get impacted, right?
Yes, but again, first of all, those facilities are not as yet being targeted as far as we're aware. I think we should wait and see what's going to happen. We are looking at something of a global economic slowdown. Let's keep that firmly in mind. The latest forecast from the IMF, OECD last week during the course of their annual ministerial meeting, they're not optimistic about global growth generally, because we do have to put all this in the bigger context of the impact of the Trump tariffs and just the general global situation, which is not particularly positive at the moment. So I don't think we're necessarily going to see demand for hydrocarbon-based exports being impacted negatively by these events in the Middle East, which, okay, the timing's a surprise, as I said earlier, but I think markets have always been well aware that Benjamin Netanyahu has a personal determination, supported by his government, obviously, to, as he sees it, finish the job of securing Israel's domestic security and paramountcy in the Middle East region.
Alistair, to understand better, what can you help us understand in terms of the impact on supply chains, various supply chains that this disturbance in the West Asian region is going to have? Because the last time we saw a similar disturbance coming in from Israel and Gaza, a lot of supply chain globally was affected. Other than oil and gas, could it perhaps be freight transportation, shipping, aviation, food perhaps to some extent? You believe supply chains over here stand to be disrupted?
Well, I certainly think within the Middle East region itself, one has an issue. Israel has already closed its airspace, as you know. As far as shipping is concerned, despite the agreement, whatever the detail of it is, between the US government and the Houthi in Yemen, there is still very little shipping actually going through the Suez Canal, Red Sea area today. So I don't see a significant impact on global shipping patterns. And if we look at wider aviation patterns, there's no particular reason why those should be seriously adversely affected by this escalation in the conflict. Aircraft can get round this area without too much difficulty. So I'm not overly concerned about global supply chains. I may be proved to be wrong. And obviously for countries in the immediate region, in which we have to include India, of course, there are some potential implications. But right now, it does look like the conflict is going to be contained within Israel and Iran and the airspace between those two. And those are the areas which we need to be a little concerned about. But again, I think there are workarounds which are perfectly feasible. I've yet to hear of any air traffic into, let's say, Dubai being disrupted, for example.
Yep, keep an eye on how things evolve. That's exactly what we can do. But Alistair, thank you so much for your time.
Vice President and Fund Manager Equity at UTI AMC. And hi, Mr. Srivatsa, thanks so much for joining us and good afternoon. First up, give us a sense of what you're making of the market at this point, because we have improved significantly from the session lows, but nonetheless, it seems like the consolidation that we've been seeing for, over the course of this week is here to stay for a bit, perhaps.
Yeah, hi. Good afternoon. I'll probably, I'll not give a day's view, but probably, go on what's been happening in the last couple of months. I think what's happened is that there's been a lot of positive flows, especially on the FII side, as people were moving away from the US markets. The emerging markets as a basket have benefited. Coupled with very strong flows on the domestic side, I think that has helped the market quite a lot. The second factor is, I think, the overall results have been pretty, I would say pretty in line with expectations, and the broader market results have been, pretty impressive. Especially the mid caps has seen a decent amount of earnings growth revival in the last quarter. Now that's kind of, led to the markets doing extremely well in the last 3 months. So it's up 14-15% in the last 3 months. And I think today, probably, given the geopolitical risks that we are seeing and the global still, the tariff-related uncertainty still exist, we probably see some kind of a pause or consolidation in the markets because, again, the valuations are again at closer to 21 times, which is slightly above the longer-term mean. So we do expect some amount of consolidation to happen, especially given what's happening on the global side.
Yeah, absolutely. But, all that aside, Srivatsa, what is your sense on valuations? Because this is at a time when we are seeing pretty much most global markets, even the S&P 500 index already at a record high. Our markets seem to be just shy of that. Are valuations for India at large looking comfortable?
See, when I look at the valuations, definitely at the large cap side, I think it is in the comfort zone. I mean, we are at closer to 19-20 times, which is not very far off from a 3-year, 5-year average. And sorry, some of the sectors like, say, banking or oil and gas are, poised for some kind of a growth next year. So we are quite comfortable on the valuation as far as large cap is concerned. But I think the biggest concern is more on the broader market, especially on the mid cap and the small cap. That trades at a decent premium to large caps. Some of the mid cap sectors are doing well, no doubt. But definitely the valuations are very high on the mid and small cap side. So I think large cap is something we are still comfortable with. So probably what we are also saying is that any kind of growth in the market, probably in the next 18 months, would be more earnings growth led rather than a PE expansion, because the markets remain fairly valued at this point of time. And yes, we also need to see what is the full impact on the, especially on the tariff part, because right now markets are pretty complacent on that. But any negative on the tariff part will definitely lead to earning downgrades for the Indian markets.
Okay. Also want to get your sense on the kind of fund flows that the Indian market is seeing right now. If this global risk aversion is to continue for some time more, we have seen a little bit of sluggishness in FII inflows in India. They had picked up momentarily, but they've simmered back again. What's your view on the kind of fund flows that we can expect heading into, let's say, the next 6 months to 1 year?
See, that's a little tough to predict how the fund flows will happen. But what has happened definitely in the last 3 months is that there has been a lot of outflows which has happened from US, because of the uncertainty there. And to a large extent, emerging markets have benefited out of that. I mean, it's not only us, but other emerging markets have also gone. Having said that, if the geopolitical situation turns more adverse or the chances of a global recession is higher, or if there are, rate hikes happening in global markets, then definitely there would be a risk off for equity, and we could be vulnerable to a kind of a FII sell-off. But yes, we have a very strong domestic flows, which are still continuing, though they have reduced as compared to the last few months, but still they are pretty strong to offset the impact of FII flows. So FII flows are very harder to predict, and what's happened in the last 3 months is probably more of flows happening from US to us, rather than any positive flows happening because the valuations look attractive or the markets look attractive. So to that extent, we are vulnerable that some of these flows could reverse in the coming months. But I think in the last 3 years, we have seen very, very strong outflows happening without any meaningful impact on the market, which is unlike what happened 10 years or 15 years back. So to that extent, I think that would not have a disproportionate impact on the market. But yes, they would lead to some amount of market consolidation, which also is probably necessary for the longer term growth of the market.
Shivatsa, just going to get back to the point that you were earlier making, that one needs to really assess the damage that is going to come by from tariffs. What segments of the market still look like they could see the damage and have not already factored in what the tariff implications would be?
See, one of them is probably pharma, while they are subject to tariff, but I think given the importance of generic pharma in overall US healthcare system, my belief is that probably, the tariffs would be far benign than what is being proposed. I think, and some of it is already factored into the valuations. If one looks at the export-oriented companies, they are already trading below mean, given this risk of a very high tariff, which could come in the pharma. I think that is something which is probably, in the price, and the probability is also not high. For other sectors, yes, there would be a meaningful impact on engineering and autos and general, other sectors which are export oriented, or even metals, because that could kind of lead to a lower commodity prices as well. And maybe to some extent textiles as well, where higher tariffs could impact the demand, but auto and engineering would be one of the bigger ones which could get impacted.
And Mr. Srivatsa, also help me with your view on the entire financial space. Now, the cheer that we had seen post the policy was rather short-lived for this space. If you had to position your portfolio when it comes to financials, would you now be relooking at, let's say, something like NBFCs, MFIs, PSU banks, or would you still continue to stick with the large private sector banks?
So valuations, large private sector banks do still offer some level of comfort, even though I think there would be a little bit more impact on the NIMs because of the rate cuts. I think a large part of the trade in NBFC has kind of played out, with a very sharp outperformance. Yes, they would be benefited more disproportionately than banks, but probably in the next, the valuation already factors in the kind of benefits which would come in from the rate cuts. Insurance as a space in the financial services still looks attractive even after the huge outperformance, largely because we believe that most of the regulations is behind us, and we are now in a period of growth and stability as far as the insurance companies are concerned, and valuations are still not very expensive, and it is a kind of a reasonably good growth sector within the financial services space. As far as the capital market related plays are concerned, I think it is probably a time for a pause because there has been a substantial re-rating within that space. So within the four buckets, I would probably be more comfortable on the private sector banks and insurance, which is there across my portfolios, and probably a little cautious on NBFCs and the capital marketplace.
Yeah, one can see that bout of profit taking already at play, in fact, on those two sectors. But Srivatsa, great to have you today on the show. Thank you for your time.
Thank you. Thank you.
Okay, let's take a very quick break on that note with news that, yes, we've definitely recovered from the session lows, but let's see how sustainable the move actually seems, because just when you thought that it's recovering, again, we've petered down just that tad bit, just hovering around the 200-point loss mark, 24,688, and the breadth remains as is, well in favor of the decline.
पैसा लगाना है
Of Motilal Oswal Financial Services. We also have Sunny Agarwal, Head of Research Fundamental Desk at SBI Cap Securities, joining us. Good afternoon to both of you. Shivangi, I'll come to you first. Given the kind of moves that we've seen over the course of the weekend, especially today, fueled because of these West Asian tensions, give us an idea of where we can expect our markets to head over the course of next week and what market open on Monday could look like.
Very good afternoon. Thank you for having me. So we've seen that, of course, global tensions and geopolitical concerns have dampened us at the opening levels. But from the opening tick itself, we saw that a good recovery was seen right till the end of the session today. And even though on the weekly basis, we formed an outside bar, which indicates that, the Nifty did catch a new high from the previous week, but it failed to hold at those levels. So some sort of pressure is intact. But overall, support-based buying is quite strong at this level. So even though we're a little bearish, but of course, there is a lot of optimism around at this level. So now, till the time Nifty holds above 24,442 mark, which is an important level here to watch out, some strength and pullback move could be seen towards 25,000 marks, which is, again, a psychological level. But a hold below the same could see some near-term structure changing and some more weakness or profit booking. But till the time it holds above 24,442 marks, it looks quite good, and this bounce could be played into. So this is the outlook for Nifty. But of course, Bank Nifty, we're seeing some bit of more pressure here. We've seen that this index has been facing profit booking from the last 4 continuous trading sessions. And today, even though we've managed to hold above 55,500, we're barely above it, and some sort of pressure can be seen in the heavyweights, which is causing some range bound move here. But overall, volatility is more expecting in Nifty.
Okay, that's what one is anticipating when it comes to the markets. Just want to check in on what the India VIX as well is up to, and whether or not you're seeing a spike coming in there or not. Yeah, a 7% move is what you're seeing. The India VIX now at 15 plus levels. Kunal, where do you think the India VIX is going to go? Today, of course, it's seeing a spike up, but does it seem like it's a sustainable move?
Yeah, today's move is more like a natural move because the markets are coming into that phase that yes, risk is now there in the markets. All the events are out, but still, with the kind of news flow surrounding across the globe, there's bound to be some adjustments over there. But I don't see this as a major spike in terms of the India VIX unless the scenarios across the globe or the news flow across the globe, it starts to, worsen significantly. So, there's an initial pop or an adjustment into the VIX where the markets suddenly braces for the kind of news flow surrounding. And then once that gets priced in, we expect the markets to remain more or less into a stable territory, and the VIX, trading at a much higher zone. So we were almost at 13.5 on the India VIX. Maybe I think we should settle in the range of 15 to 16 over the next couple of days. So I don't expect a major comeback of volatility for the India VIX as such, but I think 15 to 16 should be like a new normal for the India VIX over the next few days.
Sunny Agarwal as well on the show. Sunny, hi, afternoon. What is it that you're making of the market? Well, of course, today seems like more a synchronized global knee-jerk reaction to all the developments in the Middle East. but does it seem like we could weaken further from here?
Yeah, good afternoon and thanks for having me on the show. I think again we continue to remain constructive on overall equity market. The reason being that India's macro is on very strong footing, and at the same time, with the recent boost by RBI in the form of 50 basis point rate cut, coupled with consumption booster given by Government of India in the form of a tax breather during the budget, we feel that in terms of earning growth, many mid to small size company, or in fact few sectors can report a very healthy set of earning growth during the Q1 or Q2 of FY26, and hence we continue to remain selectively bullish on market. Any dips can be an opportunity to add quality stocks in the portfolio. Case in point, within BFSI, NBFC as a sector, we feel will be one of the key beneficiary, wherein on the liability side, all the repo link as well as MCLR link funding book will see a 50 basis point kind of saving on cost of fund. So that will be an added advantage for NBFC. And within that also housing finance as a company, housing finance as a sector, which we like more because most of the mid-sized housing finance company has got a kind of fixed rating kind of portfolio. So that will be an added advantage for them. So again, continue to remain constructive. Buy on dip is a strategy which we feel should be adopted in this current market.
Okay, so buy on dips is a strategy, but Sunny, help us understand what you're making of the broader end of the broader end of the market right now, because they are also in the red, but they've not fallen to the extent that the benchmarks have fallen. Do you believe as and when eventually when the recovery starts to show once again, it could first seep into the broader end and then towards the benchmarks?
Yeah, definitely. I think the market continue to remain a stock-specific bottoms of growth stories are something which will always find a buyer at every dip. So, as discussed earlier, a few selective name, case in point, Time Technoplast, where we feel that earning is likely to grow at kind of compound at 15 to 18% CAGR during FY26 and 27 period. So again, I think even if you look at earning construct, most of the mid and small size companies are reporting a very rock solid kind of 15 to 16% CAGR earning over the period of next 2 years. So I think broader end of the market is where you can find identify more winners rather than looking for some in the benchmark or frontline indicators.
Okay, so well, that's the take on the broader end of the market as well. Shivangi, I want to get your sense on the market churn that we've seen off late. It's surprising today how IT is holding up much better than its peer indices. What are you making of Nifty, IT, and a lot of these names over the course of the week, though they're not doing all that well today? Something like a pharma, for instance, they have been showing some signs of recovery. So what are you making of some of these sectors that have not done all that much over the course of the last couple of months, but now are showing some signs of optimism?
Now, of course, coming to Nifty Pharma first, we've seen this index has been, quite a high beta one and quite volatile to news sensitive action as well. But talking about Nifty IT, there has been a good comeback in most of the stocks today. In fact, both heavyweights and the mid cap stocks are doing quite well. There has been good amount of long addition on a consistent basis in most of these stocks. One of the stock which is on my radar is Tech Mahindra. This has done consistently well from the last 10 trading sessions, and we've seen a gradual amount of volumes being added, especially in the last 4 trading sessions. So higher highs formation here, base is also shifting higher, and it has surpassed its previous hurdle zones of 1640 levels. So clearly, this one has been a clear outperformer in this kind of a market, and I'm looking at this for the next potential targets of around about 1750 levels with a support of 1630 levels.
Right. On the other hand, Shivangi, I just want to, address some of the other names. Look at some of these small banks. I mean, to think of it, the journey for them just about started, right? The rebound when they started playing up on, or rather catching up with the large cap banking names. Canara Bank, Union Bank, for instance, or some of these capital market plays like an Angel One or BSE. What's your reading on the chart?
So definitely the smaller banking names have got attention, and we've seen that there has been good recovery today, be it Canara Bank or RBL Bank, or for that matter, some of the PSU names as well. But of course, Bank Nifty has been in some sort of a lackluster move, which is causing some, range-bound movement here as well. Some headwinds from the heavyweight banking stocks, which is causing some sort of lackluster here. But of course, some of the financials, NBFCs, and the exchange-related counters are also some spaces which are looking quite positive. Now, if you look at MCX today, there has been a lot of open interest activity which has happened today, and a comeback after the last 3 trading sessions as well. So definitely this one's on radar. Even BSE has come and recovered and managed to hold above the opening levels today. So overall, this entire space looks good, but there is some sort of follow-up action which is required for the momentum to regain here. Of course, positionally, these stocks are really well, but trading, one can watch out for this for an immediate action. But of course, wait and watch and do not carry, much for the weekend.
On some of these capital market plays and smaller banks. But Kunal, let's talk about Reliance, because before we saw the dip today, the stock was showing some signs of optimism, some breakout on the charts. If perhaps we had not seen this event today globally, where do you think Reliance would have been, and do you think the positive up move would have continued?
Yeah, it would have continued for sure, for the stock price. But then, this is how risk gets adjusted into stock price. And just being from a point when the stock was on the verge of a breakout, the stock price is going to a mild reversal. But then what matters over here is that this doesn't look like a major trend reversal for Reliance Industries. The stock was trading to a 40-point band, 1400 to 1445 thereabouts. It's come back to the middle point of the band, after this 10-15 point gap down move and a downtick for Reliance Industries. So which means that we could probably be looking at the stock trading into this 40-point band further. I think what's also interesting is that the way the stock has this tendency of going into 2-3 months of a sharp and a strong price uptrend, and post that it remains into almost like a 1 month to 1.5 or month of consolidation. So I would actually believe that the stock at 1400 levels, if it corrects to that kind of a zone, could actually be a good contra buy.
Okay, so that's on Reliance. Sunny, I want to get your view on the real estate space, because very quietly in the last couple of minutes, real estate has tipped over into the green with a very strong move coming in the names of Prestige Estates. That's about higher by 1%. Godrej Properties, Oberoi Realty, both seeing more than 0.5% gain. DLF, Lodha. So it's really these big players that are driving the move that we're seeing in Nifty Realty today. We've seen a little bit of a up move coming in over the last couple of months as well for Realty. What are you making of this entire space, and what's making this space hold on to the shade of green today?
Yeah, definitely. I think the recent rate cut by RBI set the stage for the real estate companies, wherein we feel that the pre-sales number can further maintain the good momentum going forward. Again, we continue to remain constructive on real estate names. So we feel on a longer term basis, the real estate is at a mid-cycle and there is still a runway of next 3 to 5 years in terms of real estate demand that is likely to remain healthy. So we feel that real estate will continue to find buyers at every dip. And if I have to choose few names from the real estate pack among the large cap frontline, DLF is the one name which we like. We feel that it's the balance of residential as well as the commercial portfolio is offers a favorable risk reward ratio at the current juncture. At the same time, from a mid-size, mid-cap name, we feel Shobha Realty is the one company which is trading at a reasonable valuation. Apart from that, Brigade Enterprises from again a Bangalore-based player, we feel that they have reported a very strong set of number and the momentum is likely to continue going forward.
Right, okay, that's the take coming in on the realty names right now. The list of losers today also has aviation, and that's Interglobe, which is down about almost 4%. I think it's recovered about 2% from the session lows, but still down. 52.50 is where the stock is currently. Sunny, what is your own sense if some of these names like an Interglobe Aviation or some of these, hospitality or tourism names do see a fall because of what's, really happening in terms of untoward incidences? You think these declines should be bought?
Yeah, definitely. I think hotel as a sector is a structurally a strong growth story wherein the demand is outstripping supply, and we feel that the kind of growth, especially the mid-sized hotel companies are reporting, we feel that the earning growth is likely to sustain over there. So again, there are two packs within the hotel. One is the frontline companies which are likely to report kind of 13 to 15% kind of earning growth, and there is a mid-sized pack wherein there are few companies like Sami Hotel, kind of APJ Surender Hotel. So there are few packs which are likely to turn around during the FY26. So again, we continue to remain constructive on hotel industry. Coming to airline, I think for Interglobe, there is a rumor of some block deal wherein the promoter are likely to offload 4% stake in that, and the recent spike in the crude oil prices definitely hurt the margins of Interglobe Aviation in case it's sustained for a longer period of time. Otherwise, looking at the kind of 60% plus market share for Interglobe Aviation, we continue to remain constructive from a long-term perspective.
Okay, Sunny, so that's your take on Interglobe, but also want your take on Tata Motors, because in the last, let's say 10 minutes or so, that stock has spiked up. We have positive news coming in for Tata Motors, wherein Moody's has upgraded the JLR ratings to BA1 from BA2, and it's an outlook positive that they've maintained. So, positive news flow coming in for Tata Motors in terms of this credit rating upgrade from Moody's. But other than that, Sunny, what are you making of Tata Motors as a stock? It's been on the disappointing side of auto sales month after month. Where do you see this stock headed? And if you had to perhaps pick between M&M and Tata Motors, where would you be placing your bets?
I think within M&M and Tata Motors, we would still prefer M&M at a current juncture. The reason being that during the recent analyst day interaction with the Tata Motors, the outlook for passenger vehicle and commercial vehicle segment for FY26 has been muted kind of growth, which the company is likely to report. JLR is something where analyst interaction is still pending. But looking at the current global uncertain environment, we feel even JLR can have a kind of muted year during the FY26. So although our some of the parts valuation for Tata Motors comes to 830 rupees, we continue to prefer M&M over Tata Motors. So we feel the M&M has got a better upside at a current juncture, and risk reward is more favorable. So our fair value for M&M is close to 3,500, 3,600 rupees.
Okay, so that's that on the entire auto space, but let's shift our focus to the primary market action. Is there some trouble brewing within the IPO market amid delays in fresh issues and slew of block deals? Sharad is joining us with more on this. Sharad.
Well, there seems a problem in the primary markets, and whether this is the right time to get the IPOs or not, that's also a question. Key headwinds coming in, geopolitical tensions, and interestingly, domestic cues, that has also remained mixed. Now, the global uncertainty coming in from the tariffs as well, and the DI participation, if you look at it in the key IPOs, that has actually come down as well. Block exits also coming. That means this is coming from promoters as well as FIs as well. That means inflows are being questioned, especially in the primary market. Now, what's the immediate impact? What are we looking at in the grey market as well as in the IPO market? There is a grey market premium fall in Oswal Pump's IPO. The Zepto has actually delayed its IPO plans for next year as well. Interestingly, main boards, they have become very selective, and that's why the amount of main board IPOs that are coming are very restrictive till now over the last 1 month, 2 months as well. But interestingly, increased scrutiny coming for the SME IPOs as well, especially coming from the regulators. Now let's look at the upcoming IPOs. What are the numbers looking like? 72 companies have actually received the approval from SEBI, and that's worth almost 1.4 lakh crore rupees. And the key IPOs are expected to kick in the next 2 to 3 odd months is the SDB Financial Services. The IPO size is big. That's roughly 12,500 crore rupees. And also Hero FinCorp and NSDL ranging between 3,500 to 3,700 crore rupees a piece. So of course, a larger IPOs coming in would be impacting the liquidity. But in current situation, of course, whether an IPO comes or not, that's also a question mark.
Right, okay, that's that on the upcoming IPOs. And what really has been the objective. It's been quite a, peculiar week in that sense, one would say, because Monday to Thursday just turned out to be so quiet. The markets were just dragging their feet. And then I think today is when you've seen a directional move in that sense. We've fallen, but if you just look at week to date, we've fallen about 1.1% for the Nifty. The mid-cap index has fallen about 1.5%, and the small caps as well ebbed off about 1.25% or so. IT has been a winner clearly. The Nifty IT index has put on a 3% of a move in the week gone by. Pharma as well has been a winner, 1.3% higher. Nifty Realty though has been a laggard. Immediately post policy, which was last Friday, you've seen a fair amount of profit taking come in. PSU Banks has been the same story. FMCG, Nifty Bank also shared about almost 2% in the week gone by. And then metals, auto, energy, they've all been session or rather sector laggards. But Sunny, your sense on Realty, PSU Banks, whether profit taking could continue here and whether IT could continue to see this tactical move perhaps?
Yeah, coming to IT, I think the global uncertainty which entire IT pack was facing during the fourth quarter result, I think that has ebbed significantly. And in case there is a trade deal between US and China, I think the commentary from management should start turning out to be positive in the quarter one results. So we feel that most of the negatives are already in the priced in as far as IT sector is concerned, and hence downside continue to remain limited. In terms of upside, in case the management commentary turns out to be positive during the quarter one number, then we can see a continued up move as far as IT sector is concerned. But within IT, we continue to remain bullish selectively on few names such as Coforge and Persistent, where the growth will be relatively better as compared to its peers. Moving on to the other sector, PSU, we feel that PSU Bank again trading at a very reasonable valuation, so downside continue to remain very little as far as PSU Bank pack is concerned. Within PSU Bank, the one stock which we like is Indian Bank, where we feel that the growth is likely to be relatively better as compared to the other peers. And coming to the other PSU pack, I think Engineers India is the one stock which we prefer. We feel that trading at a very reasonable valuation of 20-22 times price to earning multiple. Again, sitting on a record order book of close to 11 to 12,000 crore rupees. So again, FY26 is a year where we can see kind of 18 to 20% growth for Engineers India, and again trading at a reasonable valuation.
Some of Sunny's preferred bets when it comes to the entire IT space. But Sunny, thanks so much for joining us. On that note, we'll let you go. Lots has happened over the course of the day and the week, and we have Ashesha joining us to wrap up all of that for us. Ashesha.
Well, yes, geopolitical tensions and that continue to weigh heavy on Indian markets. We are ending in the red. In fact, we did recover from opening lows, but despite that, Nifty is ending nearly 150 points lower near that 24,740 mark. Nifty Bank too was under pressure today. Nifty Bank in fact declined